1,000 at maturity. That person who is holding this bond will be getting 1,000 at the end. So that person who is given the discount bond, he will also get 1,000 at the end. The accounting treatment is a little bit different. All right. So when face value is equal to the market value, if the bond price is 1,000 and the face value is also 1,000, it means we don't have to create a debit balance or credit balance. We don't have to issue the bond as discount or premium. All right. So let's just recap what we have discussed. Bonds always sold at market price. All right. Whatever is written on the face value, people don't pay attention to the face value. People they care about the market value. That's it. So bonds are always issued at market price. All right. Or we also call the concept bonds present value. So there are two types of interest like we discussed. One is called stated interest rate or coupon rate. So in some question it is written as stated interest rate and in other question it will be written as coupon. So it means these are the same. If the question says that the stated rate is 5%, it means coupon is 5%, which means these are printed on the bonds and this determines the interest paid to bondholders. All right. The other interest is called market rate, effective interest rate, yield to maturity, or bank rate, which means right now the prevailing interest rate in the market, or what are the demands of the investors for loaning money. And it varies by minute. So once the company printed on the face of the bond 10%, it cannot change during the maturity or during the life of the bond. All right. So it means every day or every month or every year, the market interest rate can increase or can decrease, but stated rate, coupon rate can never increase or decrease because company promised to pay or agreed to pay, legally agreed to pay 10%. So it cannot back off from its commitment. All right. So market rate can vary up and down. So assume that the stated rate is 8%, which means coupon is 8%. If market rate is 6%, so you tell me, bonds are issued at discount or premium? David.
Sorry, could you repeat the question, please?
If the coupon rate is 8% and the market rate is 6%, so coupon is sold at premium or discount?
Discount.
Why? Because company is giving them
it's
right, and market is giving them lower, right? Premium. Let's move to the other one. Okay, so if our stated interest rate is 8%, sorry about that, and our market rate is also 8%, so bonds gonna be issued or sold at par. All right. And if our stated rate or coupon rate is 8% and market rate is 10%, so what would be the bond price? Premium or discount? Because market is giving us higher and this company is giving us low. So company's bond price will be lower. We call this discount. All right. So let's talk about the accounting treatment of bonds issued at par, issued at discount, issued at premium. So first, bonds issued at par. So whenever we talk about the bonds, remember, bonds are payables. Bonds are long-term liabilities, and liabilities are also payables, always payables. So even if I write it down the bonds, So automatically it, assume that we are talking about, or automatically it means that this is long-term debt payable or long-term bonds payable, or this is long-term liability. All right. Okay, let's talk about the illustration here. Suppose that Southwest Airline has 50,000 of 9% bonds payable. So what do we mean by this 9% bonds payable? This is called the stated rate. And what we call the stated rate? All right. Assume that the Southwest issued these bonds at par. At par means the market rate is also 9%. All right. Now, what will be the entry? So bond price is equal to 50,000 multiplied by 100. Answer going to be 50,000. All right. So when they issued the bond, they receive cash and create liability. Cash increase, debit. Liability increase, credit. That would be the entry of bonds at par. All right. Now the interest payments. Suppose Southwest has 50,000 of 9% bonds payable in 5 years maturity. Payments occur each January 1st and July 1st, which means these are the payment dates. It means one date is between the financial year or accounting year, and the other one is not on the accounting year, because accounting year ends on 31st of December. But the payment is on the next day. So remember, our financial statements will be closed on 31st of December. So it means we create liability on second payment. But first payment, July 1st, will be in the financial year, so we'll be paying the cash payment. So what is the interest rate? What is interest expense or interest payments? So you see 9% multiplied by 9%. How many? Six months. And how many months a year? 12. Answer gonna be 1,250. So on July 1st, we will be paying the interest. What is the payment? Interest expense and cash. Cash decrease, credit. Interest expense increase, debit. So what about the second payment? December. Second payment will be on January 1st. But since our accounting period is expired on 31st of December, so here at the year end, Southwest accrue the interest expense and interest payable for 6 months, July through December, which means the accounting year closes at December. So remember, we are paying on January 1st. So that's why we will be recording it as a liability. So this expense belongs to previous year, not the new year. So we'll record it in previous year. So our expense increases. So did we pay the expense? Did we pay this interest? Expense is the same for 6 months. 2250. Did we pay this? No, we create liability. But our expense increases? Yes. So interest expense to interest payable. If this would be 31st of December, then we will be repeating the same entry. All right. So just pay very close attention to the dates. Whenever interest is involved, pay very close attention to the dates. Interest expense to interest payable. All right. So what happened on the payment date? On January 1st, 2015, next year, you pay, which means expense has been recorded on 31st of December, liability has been generated. So we pay back our liability. So interest payable to cash. Understand everyone? Oliver, Marco, Mirko, Noon.
Yeah.
Yeah.
Hello.
Yes.
Good. Okay. So what happened when the bonds mature? After 5 years, these are issued on 2014 and now 5 years completed in 2019. The Southwest pay off the bond. So what is the entry here? Pay off the bond, which means bonds payable, 50,000, they pay to cash. Simple. So treatment of issuing bonds payable at par is not a big deal. Simple. Interest expense to cash, and whenever you're paying back the whole bond after maturity, simple bonds payable to cash. All right. So the deal comes when bonds are issued at discount or premium. So let's just see the case of discount here. So we have illustration. Southwest Airline issued 100,000 bond of 9%. 100,000 of 9%. So this is called coupon rate. 5 years. So 5-year company is bound to pay 9% every year. But this year, the market interest rate, when they issue the bond, the market interest rate is 10%. So as the name implies, 10% is giving, the market is giving you higher interest rate. So the bond value must be a discount. So the market price of the bond drops and the Southwest receive 96,149 at issuance. All right. So what would be the transaction when you issue the bond and receive the money? How much you receive the money? 96,149.